Good morning. Welcome to our annual Barron Conference. We're so thankful everybody can be here after a couple of years hiatus because of the world's conditions. My name's Frank Maiorano, and I head up the family office, registered investment advisor, and bank trust business at Barron Capital. This is the first panel, and we're going to be covering emerging markets, international growth, and our new Asia funds. Our goal for the panel is we have 30 minutes to do the panel. And we're going to have some opening and intro and some opening remarks, and then we're going to go to questions from the audience. We do have mic runners in the audience, and it's a little hard to see, but if you just raise your hands when you have a question, the mic runner will come over to you so you can ask the questions to our panelists. And after that, we'll just go some Q&A with Michael and Anuj. So if I could start off, Michael and Anuj, if you can just introduce yourselves, tell which funds you manage, and how long you've been with Barron.
Yeah, Michael Kass, been here 15 years, portfolio manager for the Emerging Markets Fund, the Barron International Growth Fund, and co-manager of the Barron New Asia Fund.
Hi, Anuj Aggarwal, been at Barron for 10 plus years now. I'm the co-portfolio manager for the New Asia Fund, as well as assistant portfolio manager for the EM strategy.
Perfect, thank you guys. To get things started, Michael, if you can kind of give kind of a brief overview of what's happening in emerging markets and the international markets, kind of to set the stage for the panel.
Certainly. Now, you know that I don't do brief very well, but I'll try. Okay. Good morning, everybody. Happy to have you here to hear about what's happening in the international ex-U.S. world. I think my main message is that we believe it's time to take a contrarian view of this asset class. I think if we're looking at ex-U.S., you really need to begin with the dollar, and a picture paints 1,000 words. They wouldn't let me bring my AV and a chart that I wanted to show. But if you look at probably one of the most important factors in ex-U.S. investing is the inverse correlation of the U.S. dollar with the relative or absolute performance of EM or international equities. And so the question, is where are we in that cycle? The dollar is right now at a 14-year high, 14-year peak in what is typically a 10 to 12-year cycle. It's up about 60% plus against a basket of currencies since 2008. And this year, the year 2022, we've really seen a parabolic type move in the dollar. In fact, of that 60% appreciation over 14 years, 20% plus of it has happened this year alone. And that is classic peaking behavior. And we believe that we're likely, in a bubble phase for the dollar now, which has been, exacerbated by the pandemic, by geopolitics, by the Fed cycle, normalization of interest rates that's occurring. And that's probably extended the typical dollar bull market by a couple of years. Now, at the inflection point, the relentless capital and liquidity withdrawal from foreign jurisdictions, which acts as a tax on economic activity or relative yields and returns in those jurisdictions. That begins to reverse, and capital starts to flow back into foreign jurisdictions. That 60% enhancement, or the addition to relative U.S. returns that investors get because of U.S. dollar appreciation, begins to reverse. And you begin to see foreign currency strengthening and yields on sovereign bonds in foreign countries coming down. And that is very stimulative to consumption and investment in those places. It's a mirror image of the headwinds that these foreign countries have had to endure for many years now. So to us, this means, we should expect a material impact to relative earnings and economic activity, and investment returns for ex-U.S. assets once we get to the peak of the dollar. We think a U.S. dollar bear market should begin to take shape once the current Fed tightening phase runs its course. We think we're passing through peak hawkishness, we would call it right now. Yes, rates are going to rise, but we are probably, in terms of market expectations, we are probably at or near the peak in expectations of the Fed tightening cycle. We talked about that in my recent letter. And I've talked a lot in recent years about how the long-term fundamentals for the dollar have been deteriorating for some time. We've passed peak dollar demand. That means that going forward, we should expect a lesser and lesser percentage of global investment and trade flows to occur in dollars and more occurring in other non-dollar currencies. That's definitely happening. And on the supply side, given the recent years, the kind of explosion of fiscal spending in the U.S., that has led to, that's driven really a vector change in the issuance of treasuries and dollars. And so we think that we have sown the seeds for a peak in the dollar and a longer-term decline. Now, ultimately, taking an intermediate long-term view of U.S. equities, ex-U.S. equities, it's ultimately a function of relative earnings and relative valuation. We all know that valuations on this asset class is at 20, 30-year lows. International equities trade at a 30% discount to U.S., while for EM it's a 35, 40% discount. These are rare, and they speak to the kind of current negative sentiment that's prevalent. And at the peak of an outperformance cycle, historically, these PE multiples will reach parity with the U.S., which means that there's significant outperformance potential latent, right now, just on a mean reversion in valuation, in the coming years. But probably less appreciated is really the potential recovery for improving relative earnings performance on ex-U.S. And there are a number of catalysts in our view. First, the changing geopolitical environment that we're seeing now. This is prioritizing deglobalization, global security, supply chain diversification, reshoring, all things that a lot of investors would tend to think might be negative for international assets. In fact, what this means is that it necessitates a major global capital investment cycle to fund that deglobalization and change supply chains. That type of a global capital investment cycle has always favored ex-U.S. economies and equities, which just happen to be much more levered to that industrial cycle. So we think of it as a shift in wealth and pricing power away from the beneficiaries of globalization, which have been riding high for the last 10, 20, even 30 years. And that wealth and pricing power begins to move from what I would call developed world consumers, which were the great beneficiaries of globalization. And that pricing power shifts to the owners of real assets and commodities and the beneficiaries of industrial pricing power. This is just a mean reversion of the last 15, 20 years, a mirror image of the last 15, 20 years. And the largest beneficiaries of supply chain diversification, reshoring, which is a huge theme now, that would be India, Indonesia, Southeast Asia, Brazil, Mexico. So the fact is international and EM are just much more weighted to this capital cycle that we see coming, and also to banks, which are going to benefit from interest rate normalization. Last, I would just say, in addition, big drivers of relative earnings improvement would be, related to our themes we talk about a lot. And you're going to hear more from Anuj about what's happening in India. But India's virtuous investment cycle, which has been unleashed by years of productivity-enhancing reforms by the Modi administration, and China's pivot to self-sufficiency in the value-added industries, those are also big factors that can create a vector change in relative earnings opportunity looking outside the U.S. So to sum things up, we think, number one, the dollar is at or near a parabolic peak, while long-term fundamentals have been deteriorating. We think relative valuation on international and EM is obviously at 30-year lows. Third, we think deglobalization and supply chain diversification is going to favor ex-U.S. economies and assets. And fourth, relative earnings growth in international and EM is likely to surprise favorably. So we would say that now is a good time to start thinking about this asset class from a contrarian perspective.
Perfect. Thank you, Michael. Anuj, a year and a half ago, we started the New Asia Fund, and which you co-manage with Michael. Can you kind of tell us how you differentiate from the Emerging Markets Fund, but also maybe talk a little bit about the market which you're allowed to invest in?
Sure. So let me begin with good morning and a big thank you for showing up so early. I know we had the first panel discussion, so I appreciate you being here. So, we're pretty excited with the launch of the Barron New Asia Fund, which is obviously co-managed by Michael and myself. And we really believe New Asia to be a differentiated and diversified all-cap strategy, with a key focus on higher growth and strategic and forward-looking investment opportunities that is consistent with Asia's pivot in economic development. And a part of our differentiation for New Asia is that we are either not going to own or be underweight the large cap index heavyweights such as Alibaba, Meituan, Tencent, Samsung Electronics, that together contribute anywhere between 20 to 25% of the index, which are attractive businesses but are maturing and are likely going to face longer-term headwinds, as it relates to regulations or a deteriorating U.S.-China relationship. So our core focus really is going to be to identify and invest in the next generation of industry leaders that are currently under the radar and are likely smaller in market cap and size. So, we're going to invest in many businesses that, many of you have never heard of, that are, fast becoming local national champions in China or are becoming leading digital businesses in India, which are in very, very early innings of their growth trajectory. As part of our differentiation as well, New Asia is likely going to focus heavily on India, which is currently the largest country weight at about 35 to 40% of the portfolio. And our excitement about India, as Michael mentioned, really stems from the ongoing productivity-enhancing economic reforms that have been implemented by the government over the past 5 to 7 years. Just to name a few, the goods and services tax, in our view, is the most landmark tax reform implemented in the past 25 years, which really simplifies the tax code, creates a level playing field for all corporates, is accelerating formalization of the economy and yielding higher tax collections. And just to give you a data point out here, GST tax collections are up about 30% from pre-COVID levels, while the economy is just getting back to pre-COVID levels. So this is great from a government fiscal perspective, and is also creating a lot of bottoms-up investment opportunities for us. And we'll talk about more of them in the future, later. Just a few other reforms. India has also cut corporate taxes from 35% to 25%, and as low as 17 to 18%. For greenfield manufacturing. They've simplified, many land and labor laws, which has really made it a lot easier to do business in India. That's been a legacy issue with investing in India. And lastly, as Michael talked about, supply chain diversification, and given the ongoing geopolitical situation with the US and China, the government has created very attractive tax incentives for global manufacturers and supply chains, to create, to set up shop in India and diversify outside of China, which, we believe is going to be a multi-year investment opportunity. And we are seeing a lot of, bottoms-up stocks, in that theme. So thanks to these reforms, India is entering a multi-year virtuous investment cycle and putting, these reforms with a pretty solid domestic economy in play, really positions India to be, on a high growth trajectory for the next 5, 10 plus years. So, in our view, India is going to be the fastest growing large economy in the world this decade, and anticipate and expect GDP growth to be anywhere between 5 to 7%. And also from a geopolitical perspective, we usually don't think about geopolitics historically, but the things have changed. It's going to be advantage India, given it's the largest democracy in the world and has increasingly pivoted towards the West, from a military and economic perspective. And think of India as a strategic counterbalance to a rising China in Asia, from a Western perspective. So it's going to be advantage India from that perspective as well. Just quickly moving on to China. I know, all the headlines seem pretty negative, and but let us tell you, all is not doom and gloom. We are seeing a lot of investment opportunities in China as well, especially in our China value-added theme, which is really a play on China's vision to become technology self-sufficient in key industries such as semiconductors, artificial intelligence, robotics, software, and biotech. So what we are trying to do is really identify these local national champions that will have government and policy support, that are positioned to gain market share from the larger multinational corporates that are operating in China today. So they're going to gain market share in high growth industries, which is going to create, a 5 to 10 year investment opportunity for investors such as us. So just to summarize, we're really excited about New Asia. We feel it's a differentiated strategy with a key focus on India and a lot of opportunities in China as well, and other countries in Asia. And we hope to discuss New Asia in the future as well.
Perfect. Thank you, Anuj. In just 1 minute, I'm going to ask one more question, kind of tee up, because it's one of the biggest questions we have about the Emerging Markets Fund. If I could get everybody to be thinking of your questions, and then again raise your hand, and a mic runner will come over to you after we have this one question. And thank you for Anuj. You actually just teed up the next question. Michael, the biggest question we hear is about China. It comes up in every single discussion. Can you tell us a little bit your outlook on China? Where you see opportunities and how you kind of muddle through the geopolitical aspect of how you're investing in China?
Sure. Yeah, China is the elephant or maybe the panda in the room for sure.
Right.
I like that one.
So, yes, there's a lot of pessimism, a lot of recent pessimism. We think there's been a series of recent factors that's fueling that in the near term and really has triggered a near-term crisis of confidence in recent weeks. The principal factor relates to disappointment around the zero COVID policy, where, as many of you know, China's been taking a different tack on how to address COVID with much more aggressive lockdown type activity versus vaccine and herd immunity. There was some recent developments, gave room for sparked some optimism that, consistent with this recent party Congress, the leadership might signal a change or a relaxation around zero COVID. And that did not happen. In fact, in the week or two before, what we saw was sort of a rise in case counts and a kind of doubling down or adherence to this strict zero COVID approach. And that was a big disappointment. So one of the negative near-term factors. And then around the same time, the U.S. Announced a new series of technology export controls relating to semiconductor or artificial intelligence. And here we feel the communication of the U.S. intent was far too vague. It's clear that the U.S. intends to restrict these technologies for military use in China, but the wording left too much room for interpretation around commercial use. And we think that, caused markets to take a very, to discount the worst case or an escalation scenario that we believe is not likely to take place, at least not anytime in the near term. And then last was the Party Congress itself, where President Xi, made some changes to the Politburo Standing Committee, putting a couple of loyalists there that, I would say, creates questions about the decision-making process going forward and, kind of some uncertainty about what is the role for the private sector within China, what are the priorities regarding the private sector in China going forward. Now, I think it's important to say that we think that the recent market reaction is likely a big overreaction, that we see no indication yet of a significant pivot or departure from their current doctrine. I think what we would say happened there in the last couple of weeks is a formalization that they are seeking a greater balance between what they would call security and growth and development. But that shift in rhetoric has been occurring for a couple of years now. This is not something new to the market. It's more the formalization at the Party Congress that was what was new. And Xi is really the same Xi. So we think that China equities right now kind of look like the inverse of the dollar. This looks more to us like the end of something, a capitulation, than the beginning of something. And with the Party Congress now behind us, we think of that as like the U.S. election season running down, and it's sort of, you get the quieting of the political rhetoric and things begin to simmer down. We think that investors and traders have recently capitulated, and now there's room for optimism, particularly in the intermediate and longer term. And the reason for that, the key positives in our view that we're looking at are that, number one, there are definite economic and political constraints to zero COVID. And we do anticipate some improvement and signaling towards reopening in the year ahead, in 2023. In fact, there's been a big rally in China in the last several days. I think Hong Kong was up 5 or 6% overnight today. And we're going to see a huge rally in the China ADRs this morning, 8, 9, 10%, most of those names. That we think is attributed to actual, there are signals on the ground. There are provinces that are, saying things like that this current strain looks like it's much less dangerous than previous strains. That's the kind of rhetoric we're looking for, communication we're looking for. We are, also looking for news on vaccine developments, therapy developments, and we believe that China's close to announcing their own homegrown mRNA vaccine. And so, while officially they're reluctant to, to get too far ahead and announce a roadmap to reopening. On the ground, they're preparing for that roadmap right now. And we know stocks look, the markets are going to look 9, 12 months ahead of time and anticipate this inflection point. So that's one key positive factor we see there. And second is, as Anuj was just talking, with the greater emphasis on security, that's a catalyst for China to really double down on their commitment to developing self-sufficiency in these key value-added industries. Deglobalization plays both ways. All countries are going to have winners and losers in this transition. And among some of our holdings, some examples would be Beijing Kingsoft Office, which competes directly with Microsoft and is gaining massive market share on the ground in China. Kingdee Software competes, say, with SAP in ERP. Astune Automation has a huge runway in robotics and automation. Hengli Hydraulic, is a clear leader in critical industrial goods and components. Yunnan Bio is winning share in the consumer markets from the likes of Colgate in China. These are all rising national champions that are going to continue to consolidate their markets. They have very bright prospects ahead for on a multi-year, visible path. And so we remain optimistic, particularly about those, the sort of how we see the winners and the winners shaping up, and we believe it's very attractive from that perspective.
Right, perfect. Let's try to go to a little bit of a lightning round. We have about 8 minutes left, and it's a little hard to see. So if you could raise your hand and the mic runners, and go ahead and ask your question to Michael and Anuj. There's one here, mic runner coming to you over here. Thank you for raising the lights.
Yeah, I can see.
Right over here.
Yeah, it's a lot
better. He's coming with the mic right here. Right to your right.
Oh, boy.
I have a question that, so in general, all the funds, including this, they all use the same selection or analytic method, like all other parent fund. For example, we use the discount cash flow. And for emerging market and China, is it difficult to do a due diligence, like visiting the company? So basically, what are the selection and evaluation, discount cash flow, that kind of thing?
So we all use the same process. We have kind of a team of analysts where we're leveraging the expertise of, say, the U.S. analysts in certain industries, but we have our own dedicated research team, and we're doing our own due diligence. Now, I would say, in the last couple of years, given COVID restrictions, it's been much more difficult to travel in country and go meet, with management teams. We do that through Zoom, as everybody has in the last couple of years. But we have the same kind of fundamental, deep due diligence process in terms of how we think about, narrowing our universe, which is much greater than say, 10,000 companies versus, the U.S. Market, and many different, physically many different places. First, that's the role of themes for us. We're looking at on a forward-looking basis, at where we see the highest likelihood of the greatest value creation, and then we kind of identify, look for confirmation of the long-term thematic opportunity, and then begin to look at the companies and the management teams that are positioned as the greatest beneficiaries, of those thematic opportunities, and who's, leading the way in the drive for value creation.
Just to mention, just to add to Michael's point, we have a highly collaborative kind of environment at Barron where there's a lot of cross-pollination with the U.S. research team, and that really enhances our due diligence process in terms of really understanding business models, how they played out in the U.S. and how are they likely going to play out in Asia or in EM broadly. So in any management meeting, it's not uncommon to see, 2 or 3 or even 4 analysts, attend the meeting and then, obviously actively discuss, the due diligence going forward. So yeah, and also all the analysts, travel pretty frequently. Obviously, COVID's been a little tough, but we expect to travel more.
And I see a lot of our team right here. You can raise your hands and say hello.
So next, there's a couple of gentlemen over here.
Yeah.
Model, that kind of thing, or use a comparative,
we build like a 3-statement model, with projections, 5 to 7 years out, minimum 3 to 5 years, and obviously we kind of continue to validate our assumptions, based on every quarter or based on every management interaction. And obviously it's an ongoing process. So we build pretty detailed models, three-statement models with cash flow, balance sheet, income statement.
Yeah, perfect. I saw a question over a gentleman back here right there. Thank you.
Hi, good morning. Emerging markets are generally not energy independent and can cause inflation. How is those two factors affecting your investment process?
Not sure I understood. I didn't.
Can you repeat the question?
He said energy.
Emerging markets generally are not energy independent. They buy energy from other areas and can cause inflation. How are those two factors affecting, and it can affect growth stock multiples? How is that affecting your investment philosophy?
Well, actually, in the aggregate, emerging markets are actually, much more positively correlated to energy or commodity pricing in the aggregate. So there are certainly some countries in Asia, particularly India, which is a larger importer. But within a kind of an EM portfolio, you have countries, like Brazil or South Africa, which is very commodity, centric, energy or commodity centric if you're looking at Brazil, or Mexico, et cetera. So Indonesia would be the same. So, from an overall EM, perspective, those are beneficiaries of a higher inflation environment, a higher commodity price environment. And that's kind of what I'm saying about the era we're heading into is going to be more, we believe, more like the early 2000s period. And in the, I would say EM as an asset class will be positively correlated to that.
And just to add to Michael's point, as it relates to India, what we're going to see over the next 5 to 10 years is significant capital investment in renewables and green energy. When we speak to a lot of management teams, including Reliance Industries, Adani Enterprises, they have big plans, to really kickstart the renewables ecosystem in India, which will reduce the reliance on, typical fossil fuels and create, domestic ecosystems, on renewable energy and green hydrogen.
Yeah, we probably have this gentleman in the middle right here, looks like in a black shirt.
Can't get him the thing.
Thank you for taking my question. What I'm concerned about is not so much the zero COVID policy as the zero tolerance for Taiwan possibility. Is that factor into your calculus at all as far as risk?
Of course.
And
Yeah.
they could shift production to other countries, or because I do think that it's a real risk that China could invade Taiwan.
So
We have two minutes.
okay, so of course we consider that. I mean, that's really kind of long term, probably, on a global perspective, that's a big factor. I mean, that risk is not while it is not going to only impact Taiwan or China, that's a global question. I would say a lot of people look at what happened in Russia, Ukraine, and they extrapolate and talk about China and Taiwan. We would say that Russia was insignificant, almost insignificant in global economic terms, although they are significant in terms of commodity and energy flows. But they were a country that was kind of desperate with nothing to lose, I would say. Whereas China is very different. China is, the second largest economy in the world. Wants to present themselves as an alternative reserve currency. Wants to become the hegemon in Asia. The U.S. doesn't like that, but that's what their goal and where they're heading. And so they would have far more to lose. And I would say, when we think about thinking about the risk of China invading Taiwan, you're seeing it through the lens and the media as presented here in the U.S. I would say China, if you look back at, say, Nancy Pelosi's visit, which was highly provocative, they reacted to that, I would say, with great measure and discipline. I would say that, what we're seeing is particularly the U.S. is being very provocative. U.S. policy is shifting in terms of guaranteeing Taiwan's independence. That's rhetoric that we really haven't used in 20, 30 years. So it's a two-sided, the risks are kind of are two-sided. And if you look at how China's been reacting, sure, they have to respond when Nancy Pelosi flies over and has direct, diplomacy with Taiwan. But what they're doing is fairly measured, and I don't think we should expect, kind of a military type reaction unless they're really provoked in ways that are, that the U.S. it would be a miscalculation for the U.S. to go down that route as well.
And I'm getting the hook. So
Okay. So we think about it. I think all global investors in all equities would be impacted by that. It's not something we can control, but we think it's a very low probability event, like on a 5 to 10 year horizon.
China also has a lot to lose if they do it.
Too much to lose.
So, that has to be a key consideration for them as well.
Thank you. Sorry, we're out of time. We have to get to the next panel. If you have any other questions, go to your Barron representative. Of course, go to barronfunds.com. And the funds are the Barron Emerging Markets Fund, Barron International Fund, and the Barron New Asia Fund. Thank you very much for your support in Barron, and welcome to the conference.